Well, folks, I guess that's the signal that it's 10 o'clock. We'll call the August 11th, 2022 meeting of the Oklahoma City Employee Retirement System to order. I'm going to request that we get a motion from someone on the board to advance item number 15, the executive session, to the very beginning of the meeting. It won't take very long, I promise. And then when we reconvene, then we'll have the presentations from the investment managers. So, Chair will entertain a motion. So moved. Have a motion and a second. Record your vote. Item passes. We will adjourn and be back momentarily.
No, we will recess.
We'll recess and adjourn. All right, and return. I'll get it right. Okay, we are back. The board has been updated, and we will reconvene with item number 2 on the agenda, the small mid growth manager presentations. And first on our agenda is Loomis Sales and Company. Jason, you want to give us a brief update?
As a reminder, the last few months we've talked a little bit about your current small to mid-cap growth manager, Times Square, issues related to pretty significant turnover at the top of the firm and with the analyst level that led us to recommending we consider other candidates as a replacement to them in your portfolio. Small cap, you have a 10% allocation that's split evenly between growth and value, earnest on the value side, and currently Times Square. So we've gone through a process where we've narrowed down candidates and brought 2 candidates to you for consideration as replacements for Times Square, Loomis and Silvercrest. You have our material that we'll go over after the managers present, but then each of the managers have brought material, and we'll have some remarks for you to talk about their portfolios. So first up is Loomis, and I'll hand it off to you guys. Okay.
Good morning, everybody. I handed out some presentations, but some maybe not in the room when I did. Does anyone need a copy of our presentation? Great. I'll quickly hand it on. Anyone else? Thanks. Actually, hand them all out. Well, we'll go and get started here. On behalf of everyone at Loomis Sales, I'd like to first say thank you for having us here today to present our SMID growth strategy. My name is John Trital. I'm a part of the Institutional Services Group here at Loomis. I have the distinct pleasure of coming to Oklahoma for 15 years. Now, I know our presentation is short, so I'll hold the story at some point here, but it involved my wife going into labor when I was in Oklahoma City, so I had to come back for the trip here. So a long history of coming to Oklahoma. I'm excited to introduce my friend and colleague, John Slavic. John is a part of our co-head of our Specialty Growth Strategies team. He's co-PM of the SMID growth strategy we're going to be talking about here today. He has 30 years of experience managing money. Somehow I have more gray hairs than he does, though, for some reason. He joined Loomis in 2005 to launch our first strategy, which is the small cap. And then in 2012, we launched the SMID growth, which we're going to be talking about here today. Fast forward to today, the small cap growth strategy is closed to new clients because we want to preserve that alpha. But the SMID growth just celebrated over 10 years of portfolio history here. So from an agenda perspective, we're going to quickly touch upon Loomis and then spend the vast majority of time talking about the philosophy and process and the performance that John and his team are accountable for here. So with that, no questions. I know we've got 15 minutes, so I'm going to keep it short and sweet on Loomis, but if any questions, we can dive right into it. Perfect. If you want to move forward to slide 4, a quick snapshot of Loomis at a glance. We have a rich history of managing money on behalf of clients dating back to 1926. As you can see, about half of our assets are institutional assets of the 290. And we're really proud of our relationships in the public funds. In fact, the public fund channel is the largest in Loomis Sales. If you move forward to slide 7, here's a list of our representative public fund clients. We're very proud of our relationship with the public funds. I'm honored to say that we have 4 Oklahoma public funds as clients, with the oldest one dating back to 1999. So we really value the relationship in Oklahoma, and we're excited about meeting you here today. So with that, I'm going to hand it over to John to talk a little bit about the philosophy and process. And there's a tagline of our strategy. It's called Lower Volatility Approach to High Growth Investing. And John's going to go through some of the differentiators of that approach. John?
Great. Thanks, John. Well, thanks very much for inviting us to be here today. I can't tell you how nice it is to do this in person. We spent the last 2 years doing these types of presentations over Zoom, so thank you for inviting us to come out here. It's certainly a pleasure, and hopefully we can be part of helping solve any kind of goals that you have going forward with your plan. As John said, I'm the co-portfolio manager of the small cap growth, the SMID growth, and the mid cap growth strategies. My partner and I, Mark Burns, we started the small cap growth strategy in 2005 with our own process that we sort of created from scratch, and that process has persisted now for 17 plus years. It's the same process that we use with our SMID growth strategy, which we launched in 2012, so just over 10 years ago. I'm going to respect the time limit here, try to keep you on time. I'm just going to use a few slides. I'm not going to plow through this whole book, so hopefully that makes everybody feel a little bit better about things, and really spend most of that time talking about what we think makes our process different from our peers. Before I get to that, I wanted to mention on slide 9 where we list our capacity for each of our products. And what's important is that for this SMID growth product, we are approaching what we refer to as a soft close, where we're going to shut the product down to new clients after we fulfill this pipeline that we have in place. The reason that we do that is completely tied to the best interests of our clients. We are believers that in the small cap growth and the SMID growth space, the greater the AUM, the more challenging it is to generate alpha after you get to a certain point. So we did the same thing on our small cap growth product that we're doing here in our SMID growth product. When we approach this $3 billion level, we are going into a soft close. The nice thing about working at a firm like Loomis, where you have multiple products across multiple asset classes that are all generating revenue for the company, there's no pressure for any one product to become outsized, growing to an unnatural asset level just to drive revenue for the company. They want you to do what's right for your clients, preserve alpha, and keep those clients for a long time, and that's our goal as well. So we're very aligned with our clients in this. Before I get to the philosophy and process, I just want to mention that when we went ahead and started these strategies, we had a few goals in place, and our philosophy was that why start something without having goals? And there was 3 very simple goals we had. Number 1, we wanted to make sure that we emphasized our strengths. We always thought that stock selection was a core strength of ours, and as long as you surround that with a disciplined process, that can really drive strong alpha. So if you look at the attribution for this product over time, you'll see the majority of excess return comes from stock selection. The second goal was to make sure that the product could scale. What do I mean when I say that? Well, it's that what you'll see oftentimes with managers, as the AUM, the assets under management of their product grows, you'll start to see things happen like name creep. There'll be more names coming into the equation because these are liquidity constrained areas of the market. You'll start to see the style drift a little bit. We did not want that to happen, and so what we started to do from day one was to run this product as if it was already at capacity, so that the characteristics on day one look exactly like the characteristics in year 10. And they do. So that track record has been truly driven by that same process over time. It has scaled. And then the third goal was to make sure that we were managing risk. And we always felt like if you wanted to have a true small cap or SMID cap growth strategy and have any kind of a consistency of returns, with consistency being the key word, you needed to manage risk. And I'll talk a little bit more about risk in a second. So what have we produced for our clients today? This is the only time I'm going to really flip around in the book, but if you could flip forward to slide 25, please. Okay, in slide 25, this is a snapshot of our product since inception, and on the left-hand side of the screen, you can see the gross annualized returns to date. But more important, and down below, you can see where that ranks in the peer group, but more importantly, in the middle of the page, you can see the risk-adjusted returns, the Sharpe ratio, the information ratio. These are industry standard metrics that are used to inform people how much risk a manager is taking to drive the kind of returns you're getting from them. And you can see that in these cases, our risk-adjusted returns and where they rank in the peer group are at the same level, if not better, than where the gross annualized returns rank. And that makes us very happy because that was our goal all along. Generate a good level of absolute return for our clients, but do it without taking on an excessive amount of risk. And I think that's what those returns will show you. We do have another slide in the appendix, which we don't need to go to now in the interest of time, that has the same slide for the small cap growth strategy. We put that in there because that strategy has been in existence now for almost 17 and a half years. Same philosophy, same process, and it can show you that over an even longer period of time, what this process is capable of producing. And when you think about the types of markets we've had in the last 17 and a half years, it has really been battle tested over that period of time. So I'd ask you to just flip back to slide 11. From a philosophical process, very briefly, we've always been big believers that when you're looking for secular growth stocks, that high-quality business models tend to generate a more consistent level of returns. But beyond that, if you can find these high-quality business models where the stocks have yet to be exploited by the market, not only can you generate a more consistent set of returns, but you can generate a more consistent set of excess returns. And so quite simply, what we're trying to do with our strategies is populate the portfolio with these types of secular growth names. So how does that work its way into its process? On slide 12, and this is the last slide I'm going to really use in the book, we feel that the best way to discuss our process is to really focus on our differentiators. What do we do different from our peers? Now, other than the performance slide, this is probably the most important slide in the book. This is not the most dynamic slide you've ever seen. It's a 3-bullet point slide. I love this slide, though, because this is the slide that we really came up with a couple of decades ago to describe the process, and it hasn't changed. The first differentiator is how we handle idea generation. Now, Mark and I have always liked to look for these secular growth stocks that had a very specific set of characteristics that we felt made for good stocks on a go-forward basis. There's a couple of ways that people go about doing this. Most of our peers use what they call the traditional method, where you're talking to company management teams, talking to industry contacts, just trying to get smarter about those spaces in the market so you can make better decisions when you're buying and selling stocks. However, early on, we felt it would be useful to us to build a proprietary growth screen that helped us to narrow in on these characteristics in a much more rapid pace. And what's unique about this growth screen is that there is one metric in particular that helps us to identify the level of exploitation in every stock that we're looking at in our investable universe. And without going into detail on that, within the interest of time, and I'm happy to answer questions on that later, what we do is we know when we're looking at a stock that is either overexploited or underexploited. And when you're looking at underexploited stocks, that means, by definition, you have a greater competitive advantage of having a positive outcome on your research. And so that's a very important part of that screen. So differentiator number one, idea generation, the use of this screen, but particularly that one metric that helps us understand where we have a competitive advantage. The second differentiator that we list here is valuation analysis. It's a bit of an odd differentiator, but we'll look at a lot of the traditional metrics that our peers will look at, such as price to earnings ratios, cash flow multiples, enterprise value to sales, what have you. The problem with these traditional metrics is that they don't do a good job of telling you the whole story. So why is that? Well, in often cases, you're using different metrics to look at stocks in different sectors of the portfolio. And in some cases, you're actually using different metrics to look at stocks in the same sector of the portfolio. So how do you get an apples-to-apples view of every name in the portfolio? Well, early on, we started using discounted cash flow modeling. And what we like about that is a few things. Number one, it solves that problem, gives you a single tool to look at every stock in the portfolio on a level playing field. Number two, the beauty of a discounted cash flow model is it focuses on a company's number one way to drive wealth for its shareholders, and that's an ability to generate cash. The DCF model, discounted cash flow model, rewards companies that are superior allocators of capital, and it punishes companies that are poor allocators of capital. So by use of this tool, when we're valuing our companies that we've put all this research into, it's pushing a higher quality bias into the portfolio. And we really like that aspect about it. So that's something that we lean on a lot. We like what it does for us. It gives us a differentiated lens to look at the market through. And the reason we refer to it as a differentiator is that while we certainly see a lot of our value, small and mid-cap value peers using discounted cash flow analysis, we don't see too many of our growth peers using it. So we like to highlight this and think it like I said, it gives us a bit different of a lens to look at the market through. Third differentiator is risk management and how we handle that. Risk management is very important to us. It's something that we do from the stock level up to the portfolio level, and from that initial buy decision all the way through to that sell decision. And what's critical about this is that that sell decision has a very clear and unemotional stop loss strategy associated with it. Now, why is that important? Well, I don't say this lightly. Buying stocks is a lot easier than selling stocks. Selling stocks is a much more emotional part of the process. You've put a lot of work into these names. You've researched them, in some cases, for hours and hours. You've gotten to know the management team. There's a behavioral connection you build. It's harder to sell stocks. That's the downfall of a lot of managers. And so what we did is we put a tool in place here that helps us get out of fundamental mistakes early, and it's an unemotional tool. And again, I'm happy to go into more detail about that. In the interest of time, I won't. But this unemotional stop loss is one of the factors that helps us to produce that downside capture that was back on that dot chart on slide 25, I believe it was, as well. We don't have to go back there now. But you can see where that ranks in the peer group, the downside capture, helping protect our clients' capital to the downside. So we think it's a very useful tool. So when we wrap these differentiators together, that's where we come up with this tagline, and John referenced this once already, a lower volatility approach to high growth investing. We don't like to put things in the book or say things that aren't true. We feel like the proof behind that statement are those risk-adjusted returns that we looked at in the back of the book. So those are our differentiators: how we handle idea generation, how we value our companies, and how we manage risk. So in summary, and there is a summary page, and it's really not an important page here, but it's on page 21 if anyone cares to look at it. The process is a repeatable process. It's a disciplined process. There's nothing in this book that we do not do. There's no slideware in this book. And the process has 17 plus years of history behind it, where it's been used in all types of market environments. We've integrated risk management to really help control that downside capture and ultimately to lead to more consistent returns so we can get this low volatility approach to high growth investing. So I hope that I didn't keep that too brief for everyone. I do want to respect your time. Thank you again for having us. I truly mean it. If you have any questions, I'd love to answer them.
Anyone have any questions?
Yes, I've got a question.
No, you got to turn it on.
Okay, the light went off. It's on now, right?
Yep.
Okay. Just a couple of quick questions. Very good presentation.
Thank you.
I can see why you two are so successful at what you do.
Thank you.
One of them has to do really with just a personnel issue. I noticed over on page 10, it was footnoted that James Lamb has left the organization. Can you expand on that a little bit?
Yeah, thank you for asking that. So James was with us for about 14 years. James is a casualty of the pandemic, unfortunately. Initially, when we went into remote work, he's got a young family at home, beautiful young family. It was a challenge for him, and I think that over the course of that time, as he told us, and we've been back in the office since September of last year. However, that family to work connectivity, I think, was a bit of a challenge. And he came to us back in June and said, I'm leaving the industry. And I'm going to tell you exactly what he told us. I'm leaving the industry. I've done a lot of soul searching. I've lost the passion for the business. And quite frankly, I'm burned out. And so he's going to Wayfair. I'm sure you've all heard of them, probably bought stuff from them as well. Please don't send your returns to me to give to James. He went to Wayfair to become the head of investor relations. It's a good move for James. I think it'll be a good job for him. We hated to lose him, but when somebody tells you they've lost the passion for their job and they're burned out, not only did he do himself a favor, but quite honestly, he did us a favor, because if you try to fight through that, if you try to persist, that's going to show up in your work. and ultimately in our results. So it's unfortunate to lose him. This is an industry, as you know, that tends to have a fair amount of turnover, and we've been very fortunate not to have a lot of turnover. So we will deal with that. That is a role that we'll fill. We have some younger people on our team that have really stepped up their game and are bright, intelligent young people that are taking that next step up in their career, and we feel really good about that. We've always made sure that we invested enough in our infrastructure to make sure that our clients were taken care of. And when I mean clients taken care of, I don't mean by phone calls and conversations, but by performance. We will do all that other stuff too, but performance being the most important thing, risk-adjusted performance. So we will fill that role, but it's not something that we're going to do without a lot of thought.
Thank you. Well, that's,
Sure.
He covered technology,
Yes,
which is the biggest sector in your portfolio.
correct, yeah.
You also, have you been covering that?
Yes.
sector along with him for some time?
I have, and so I've covered technology since the early '90s, and we have a young analyst on our team, Colin Hickey, who's been with us for a few years now, and Colin is taking on a bigger role within technology. One of the nice things, in my opinion, about the most recent rebalances in the Russell indices has been we got to a point where just as the value indices became almost like financial services funds in the small cap and SMID space, and the growth indices became tech and healthcare funds, the last couple of rebalances have started to level out the playing field a little here. Technology is still a big, important part of that. I do not believe that the tech names that were leadership in this last bull run, especially through the pandemic, are going to repeat as leadership. That doesn't mean we're not going to pay attention to those, but I don't think tech is going to have the same kind of influence on market returns as it has. Regardless of that, we will find somebody to help work in that sector as well. So hopefully that answered your question, Jason.
appreciate your answer on that. It sounds like fortunate you've got good coverage on that with your background, that you can just step right into that role and go forward. And it's also very encouraging that he would step up and be that truthful and straightforward with you.
Yeah.
I hope he does well in his next venture.
It takes a lot to admit that to yourself, and so if you knew him, he's a fantastic individual. But yeah, it was a big move for him, and I'm glad he did it at the end of the day. Unfortunately, but
Yeah,
it was the
things
right thing to
happen.
do.
They even had a celebratory lunch when he left, so this was not.
Good. I have one other question for you. Excuse me. On page 28, shows the small and mid-cap representatives in here, and I noticed that the energy sector, which happens to be one of the sectors that happened to perform well out of all of these sectors, I think all the other ones were in negative, but this is the only one that had a positive, that there's a smaller allocation to that. I was just wanting to ask you, would that have anything to do with ESG policies, or could you just expand on, why that lower role within that one sector?
Sure. No, happy to do that. It is not an ESG decision. We're aware of ESG factors with our companies and ratings. It is not at the core of what we're doing here. We are trying to pick good companies that allocate capital properly, and as a result of that, that's our form of ESG. We do think the market actually does a pretty efficient job of punishing companies that aren't doing something that is beneficial to any aspect of the economy. Essentially what happened with energy is on this most recent Russell rebalance, that weighting in the benchmark, I believe it more than doubled. And so it took a significant step up. Every June, the Russell indices do a rebalance. They reconstitute themselves, and certain stocks move up and out. Some stocks fall down below. Some stocks move to the value index, what have you. So there was a significant increase in weight this time around. So we weren't as underweight before going into the rebalance. The other part of that is it is hard to find. They are out there, and you can find secular growth companies in the energy space. It's a bit harder to find, and you do have to take into account the fact that there is going to be this correlation with the commodity. And as the commodity was shooting up to $120 a barrel, at least on WTI, it didn't feel like the best time to be moving to a higher weight position in that. I think now most of these oil company budgets are, I think they're based on $65 crude, and I can't remember what the gas is, like something closer to $3 nat gas. So we don't think any of the budgets are at risk for the oil service companies that tend to be, some of the growthier companies that we can find. But it's probably a more appropriate time now to be looking at some of those names again.
Okay. Fair enough. That's a good answer, and I really appreciate your presentation. You did very well. Thank you.
Anyone else?
Yes, sir.
Allocation, team's assets under management. The mid-cap growth, what is that, 4.7 million?
Yeah,
Million, is that a typo, or?
No, I wish it was a typo. It's not. No, we started that product January 1st of 2020, which please don't look at that as a reflection of our judgment on timing. It was bad timing. It's seed money from our parent company, and then myself, my co-PM, have money in that as well, but it's primarily seed money from our parent company. We will have our 3-year track record at the end of this year, so that product will be marketed. It would be a little more appealing to institutional investors at that point, but that is not a typo.
Okay.
And that was part of the plan, start with small cap growth. Now that's closed. Mid growth is now closing, and then the same philosophy and process to the mid cap growth.
Maybe it was a good thing that you didn't have more in that starting off.
Yeah, it's a strange asset class. I think that it will be a successful product for us, especially riding on the same philosophy and process. And we have staffed ourselves appropriately to handle that, just so everyone knows. But we're patient. We let these things take their time. We're not trying to rush anything here. So.
Now, I know we're going over our allotment. Maybe one last comment. Page 33 is the proposed fee schedules for our strategy. It's understanding you currently have a separate account. We both offer a separate account for this strategy as well as a commingled fund. The commingled fund is about $850 million in assets and 23 investors. The average size of that investor in the commingled fund is about $40 million. So very similar in the allocation that we're being considered here for today. And you can see that the fee is much more attractive than the separate account.
Okay.
So we went over our 15 minutes. We can.
You're fine.
Okay.
You're fine. Anyone else? Okay. Thank you very much, gentlemen. We appreciate you making the trip, and
Happy to do so.
Thank you very
for
much.
us.
Thank you very much.
Thanks.
Keep going.
Good morning.
Set my phone here so I can keep an eye on the time. I don't want to keep you beyond, I think we have an 11 o'clock hard stop, and we'll try and end earlier than that so we can get some time for Q&A from you guys. Okay.
Well, good morning. You can proceed when ready.
Great.
Bye, Jim.
Thank you. I guess I'll just first off start out by saying thank you to all of you for the consideration and the opportunity to come in here and talk about our team and our investment strategy. So we appreciate that. So thank you for that. As a matter of introductions, my name is Jim Klaus, and I head up our client and consultant relations effort for our Milwaukee-based growth equity strategies. Steve Lilly here is a portfolio manager on the U.S. small cap growth equity strategy, which is the strategy we're here to talk to you about today. So in terms of who we are, if you turn to page 4, we're an asset management firm with a long history of managing investment portfolios for both institutions and high net worth client portfolios. We were founded in 2002. We've evolved into a publicly traded company with a strong partnership culture, whereas approximately 40% of the firm is employee owned. We're responsible for just over $20 billion in assets under management, discretionary assets under management, and our firm is structured with 8 offices across the U.S. The Milwaukee office, which you see at the bottom, is where Steve and I operate out of. That's where the growth equity investment portfolios are managed. That office was also formerly known as Cortina Asset Management, which was founded in 2004, which is also the inception date of the strategy that we're here to talk to you about. So the last point that I'll mention, which is the one that we're most proud of, is our culture of high quality investments, risk management, and preservation of capital. And that culture is really stressed across all the different facets of our business. It's evidenced in our business strength and strong financial position. It's evidenced in the types of employees that we hire. And importantly, it's evidenced in the types of investments that we target on behalf of our client portfolios, which Steve will get into in more detail.
While you're on that, can you just touch on you guys were the Cortina team.
Yep.
Milwaukee offices and the whole Cortina group. What was the impetus for you all to become part of Silvercrest?
I would say in short, scale was important. As a small boutique firm, there were a lot of challenges that we faced in the industry. And the opportunity to find a partner that offered us a bit more scale in terms of trading capabilities, in terms of better resources, back office resources, really across the board, made sense. And I would also add that it really had to be the right partner. And so it's not like we were super motivated to find a partner, but if we found the right partner that made sense, we would go that route, and Silvercrest definitely has been that case. And I guess I would also add that in terms of, that acquisition happened in 2019, so we're on our 3-year anniversary this year. And I think, from our standpoint, all the folks in Milwaukee, I mean, we couldn't be more pleased with how that has worked out. And so the investment team is all the same. So it's really our small office in Milwaukee, but we're part of a much larger organization. But in terms of autonomy and how we do things in Milwaukee, it's really has been no change, quite honestly. If you turn to page 5, I'll just quickly go over where we're at in terms of assets under management. As I mentioned, the firm as a whole is right over $20 billion. And then our Milwaukee-based growth strategies right under $1.4 billion. And in terms of the types of clients that we have, it's really all the traditional institutional clients that you can think of. So we have a lot of public funds, corporate pension, really across the board. And so I guess with that, I'll pause, see if there are any questions. If not, I'll turn it over to Steve.
All right, great. Thank you, Jim. And I'll just echo what Jim said about joining Silvercrest. The goal with them was to get more scale and get more sort of just ballast behind us for operating in choppy times. And when we went into the pandemic, we couldn't have had a better partner. The technology system they had us on allowed us to work seamlessly from home. It would have been a challenge as a small boutique as Cortina. We'd have done it, but it would have been more challenging. So they've been a great partner from that standpoint. And as they said when they acquired us, that we don't know growth stock investing. We're value shop. We know wealth management. We know that. We know institutional asset management. We don't know growth investing. We have no intention of interfering with what you do. And they've been very true to that. So it's been a great partnership in a little over 3 years now. I'm going to try to turn a 20-minute presentation into 10 to keep us on schedule, so I'll bounce around a little bit and I'll skip over a lot, but I'll try and hit the real salient points. If you turn to page 7, just talks about our team. And so I'm Steve Lilly, I'm the co-manager of the strategy. My partner Brian Bees and I have been managing this strategy for over 15 years together, and Brian predates me actually by a few years on that as well. And so we've been through a lot of market, a lot of different types of markets. We've been through the Great Recession, we've been through the pandemic, we've been through meme stocks, we've been through it all. And we've learned a lot through all of those things. We continue to grow as a team, we continue to grow as managers, and our strategy continues to get stronger as the years go by. And so we always think we've seen everything the market has to throw at us, and then we get something else the next year, so we're anxious to see what the next 10 years bring us. We're joined on our team by 4 really high quality, really talented analysts. They cover the most important sectors for growth investing, that being technology, consumer, industrials, and healthcare. Those are the areas where innovation is more important than scale, and so we've got analysts covering all of those. It's a very high quality team, all CFA research staff. We average just under 20 years of experience in the asset management industry, with our most junior analyst having over a decade of experience. And so we're, again, very experienced, high quality research team. And we are supported with our own trader in Milwaukee, Pete Myrek. He's been with the firm for almost 10 years. Small cap trading is an art and a science, and so Pete's very skilled in both of those. He's been in the business for 25 years, so total pro there. If you turn to page 10, we'll just introduce you to our philosophy, and we're going to spend a little bit more time on here than the rest of the book, because I think this is important. We are early investors in innovative growth companies. That's what we build our process around, that's what we build all of our risk management around, that's what we build our idea generation around. And what I mean by early investors is we want to invest in companies early on in their growth phase, oftentimes before it's evident in their financials, before it's evident in the Wall Street estimates, and certainly before it's evident in their margin profile. So we want to be in the companies as they're maximizing their competitive position, they're maximizing their strategic position, and they're maximizing what we think is the long-term earnings potential of the company. So that's what we mean by being early. Innovative is, as small cap investors, we think that small companies are the ones that drive innovation in the economy at all times. Larger companies are a little more lethargic. They kind of like the status quo, right? So they're doing well, they're large companies, they're industry leaders, they don't want change. The small companies, they want to become those large companies. The only way to do that is for them to drive change in industries, to disrupt industries, create new products, and generate new markets. And you think about, like, one great illustrative example is Blockbuster. They could have been the leader in VOD, they chose not to be, because they had this massive infrastructure of stores and all of that, and they didn't want to give that up. They didn't want to risk that. They could have bought Netflix for $100 million. They passed. Blockbuster's now bankrupt. Netflix, while they're not perfect right now, it's been a wonderful, wonderful business. Same thing in e-commerce, Amazon and Walmart, et cetera. But the point is, it's really the small companies that are driving the innovation because they're more nimble and they've got the motivation to do it. And that's what we look for. And then lastly, growth. We want companies that are growing their business and that we think that when we buy them today, years from now, they could be multiple times the size that they are right now. And you can get there through profit growth, but you really need to get there through revenue growth and through coming up with new products, entering new markets, and doing all of that. So that's what we look for in growth is what is that revenue growth generator that they have? What is that engine they have? And the profits we will see, we want them to come eventually, but we're not going to be focused on that today. That's not how we're going to evaluate companies today. If you turn to page 11, this just goes through, I'm going to tell you just real quickly how we get our ideas. We can't, since we're not looking for companies that are maximizing their profits and their earnings today, or even showing the highest growth last year, but more forward-looking, we can't use quantitative screens to find our ideas. So we find our ideas by going out and meeting with companies. Since the firm was founded in 2004, Cortina, the predecessor firm, our research team in Milwaukee has hosted over 1,000 meetings with company management teams every single year. Pre-pandemic, those were all in person. They involved a handshake and communication back and forth. During the pandemic, we were introduced to the wonderful world of Zoom meetings, which were great. Our volume of meetings skyrocketed. We did over 2,000 meetings. But we're really happy now to be in the hybrid world where we're getting both the quality of the in-person meetings. We got 2 analysts at conferences this week, and we can augment that with the Zoom meetings and still maintain that volume. That's primarily where we find our ideas. Another key area for us is themes. We are thematic investors. We have a number of themes in the portfolio that help us to steer our research efforts to areas where we think that there are undeniable tailwinds that are really secular in nature. I say think, but really our themes are kind of incontrovertible. One example would be minimally invasive healthcare. This is a big trend. We're trying to inflict less trauma on patients while we fix whatever ails them, get them out of the hospital earlier so they can recover faster. That's not going to stop, right? It's been in the portfolio for years. It'll be there for years to come. And so if we meet a company that participates in that, we know they've got this wonderful tailwind behind them that's going to help them grow. So themes and company meetings are where we get most of our ideas. Page 12, I'm sorry, just runs through what we look for in the individual companies that we own. And as small investors, we invest across the entire market cap spectrum of the small cap growth world. So that's companies as small as $100 to $200 million in market cap, all the way up to $5, $6, $7 billion in market cap, depending on how the index is structured. And we think being in that early part is a key advantage to us. We love that down there because A, that's where the innovation is coming from, but B, there's just not a lot of eyeballs on the smaller companies out there. A lot of companies want to manage $3, $4, $5 billion in a small cap strategy. We've got ours capped at $1.5 billion. It's a hard cap. It will fluctuate based on market conditions, but we do that because we want to maintain that flexibility to invest in these earlier companies earlier on in their growth phase. And if you do that, you've got to define quality of a business. Jim talked about the quality focus we have at Silvercrest. You have to define it a little bit different than what a traditional asset manager might define quality as. And so for us, we've come up with what we call our success characteristics that our companies are going to possess, whether they're $200 million in market cap or $5 billion in market cap. It starts with business strength, and that's really what is it about this company that is special? What is it that's going to allow them to go from being small to mid-sized to large someday? And it's got to be really special because we know, look, all of our companies have competitors that are bigger than them, have more resources than them, and more recognition than them. So if they don't have something that's truly special, they're going to lose. And so that's where we focus a lot of our efforts on is what is it that's really special about this business? One way to see that is if a large company entrusts a very key process to this small company. That's a great endorsement from a global leader. We like that. Another way, which dovetails into financial strength, would be to look at the company's gross margin profile. While small companies might not be maximizing their net income profile, they're going to be maximizing gross margin. And what's really important about that is two things. One, it shows that they have pricing power. It shows that they're not just desperate to get business and they'll give it away at any price. They've got something really neat, and they're going to make sure people pay them a fair price for it. And so if they've got industry-leading gross margins as a smaller company, that tells you they've got something really good. That dovetails into financial strength. Again, we're not too concerned if our companies have the highest net income margins or return on assets when we invest in them, but we want to see that they've got a nice gross margin profile so that as revenues grow, there's a lot of money coming down that they can invest in sales, marketing, R&D, all the other things they need to run a business. And so that flows through there. And then we'll also model the companies out and look to see that, okay, there might not be the most profitable businesses today, even though 80–90% of our companies are profitable, the vast majority of them are. But as they grow, we can see the leverage points in the model that's going to show them to be those companies that are going to have really high returns, really high margins, and are going to show up on a lot of people's quantitative screens 12, 18, 36 months from now. Leadership, I'll just touch on it real quickly. We've structured our compensation so we're very aligned with our shareholders. We start accruing bonuses when we beat the benchmark. And most of that's geared towards the 3-year, a little bit towards the 1 year, so it keeps us focused on the long term, but makes every year matter. We want to see that our management teams are also incented so that if they do well, or if shareholders do well, they'll do well, but not the other way around. And then we also want to see for smaller companies that they've got really good boards with a good diverse background behind them. So it's not, think about for a healthcare company, we don't want to see 5 doctors on the board. We might want to see 1 scientist, somebody with regulatory experience, somebody with financial, sales, legal, et cetera, people that can really be of good counsel to that CEO as they grow. In valuation, it's the last thing we do. We're growth investors first and foremost, but we care an awful lot about valuation. We do it last because those first few things are going to tell us what companies we want to own. Valuation is going to tell us when we buy them. So the research tells us what to buy, valuation tells us when to buy. And if it's not the right price today, that's fine. We'll put it on the watch list. That'll be an ideal source down the road. Usually we get our opportunity to buy it on our terms, and if we don't, that's okay. We don't need to invest in every company out there. And then I mentioned themes, so we'll skip over that. If we turn to page 14, we talk a little bit about sell discipline and risk management. And this is an area that, as I say, we've been through a lot of ups and downs in the market and in our strategy as well. We've had some wonderful periods, and we've had some other real learning experiences. And this is an area where I think we've gotten much, much better on the risk protection. I mentioned we don't do any quantitative screens on the front end for idea generation. We do a tremendous amount of quantitative analysis on the back end once we've constructed our portfolios. We run many different quantitative tools every week to identify companies where the stocks just aren't behaving the way we think they were. Short interest has gone up, volume has changed, it's hit our price target, various things that are going to trigger just extra research on that company on that day. We're also very disciplined now around sector allocations and industry allocations, making sure that while we're going to let the companies and the ideas dictate how the portfolio is structured, we've got these guardrails that keep us from getting too far out, overweight or underweight one sector, or from a market cap standpoint or other factors. And then on selling, it's going to come down to if we think the risk reward no longer favors our client, that's when we're going to sell it. It can be valuation. Valuation tells us when to buy. It will oftentimes tell us when to sell as well. Or it could be that something's just gone wrong. The prospects for the company we don't believe in anymore. We've lost faith in management, what have you. That's going to trigger a sell. Page 16, I've got 2 more pages, and then we'll open it up to Q&A. This is representative as of is June 30th, and I mentioned the 4 most important sectors for growth investors: technology, healthcare, industrials, and consumer. There they are. They're the biggest ones in the benchmark, the biggest ones in our portfolio. Typically where we're going to have the most overweights in the portfolio. We have nothing against utilities and real estate and energy, and we do occasionally find investments there, but those are areas where really scale is more important than innovation. It's hard to find a really disruptive utility company out there. Occasionally, but not too often. Typically 90 to 120 holdings. We can really tighten that up and say most often we're 95 to 105. Average positions are about 1%. And then the last page I'd like to share with you is all the way back at page 23. This is the same portfolio, and it shows you from a factor standpoint sort of how we profile. And I mentioned being early investors in innovative growth companies, and I talked about strong financial positions. That shows up here. Our weighted average market cap about 25–30% below that of the benchmark. We're very comfortable there. Our growth rates are higher than the benchmark by a reasonable amount, and again, our companies aren't even maximizing their earnings growth yet. But it's still there. Balance sheets, 48% debt to cap, just over half that of the benchmark. So we think we're being honest there. And then on earnings, we'll pay a slight premium for it, for what we're getting. We think it's worth paying a premium, especially considering that we still have this long phase of profit maximization ahead of us. And so those earnings will come, and that valuation will look smaller. And if you turn to page 28, that just shows those 4 metrics going back over time to 2017. Now, we could take this all the way back to 2004 when the strategy began, and you're going to see very similar things. We're smaller than the benchmark. We've got higher growth rates than the benchmark, stronger balance sheets than the benchmark, and we're willing to pay a slight premium for that. We think it's well worth it. And what this tells you is we're not trying to time markets. We're not getting aggressive and defensive. There are going to be times where our strategy is not going to shine, but we're going to lean into what we do best. We're going to continue to do this, and we've always come out of those periods with really good performance on the other side. So it's going to be a consistent strategy, consistent process, and a consistent profile that you would get with us. So with that, I'll open it up to questions. I think we still have a few more minutes left, so sorry for the speed run there.
Does anyone have any questions? I've got to leave. I've got another commitment, so I'm going to turn it over to Ken, and he's going to take you the rest of the way. So if anybody has any questions, go ahead.
Great. Thank you for your time.
Good. Yeah, I do have one question for you. Good presentation. I actually had a couple of other questions, and you covered them, so we'll just skip right on through that. No, there is one that I noticed on some of the summary data that our consultant had provided, that kind of a different approach that you take to research. It's noted that you have a bottom-up and a top-down approach, and seem interested in, the macro, looking at the environment as a whole and not just industries. Could you expand on that a little bit for us?
Yeah, sure. And I would say our approach is predominantly bottom-up. We're going to let the companies sort of tell us what's going on in the economy. We're going to let the companies tell us what the interesting parts of the economy are. I read macro research as I have to in my role, but we try to not let that sway us too much. The stock market and the economy are 2 very different things, and so we really focus more on the bottom up. From a macro standpoint, we do have our themes, and our themes sort of also tell us what parts of the economy have these secular tailwinds behind them, and they'll help steer our research efforts and our assets. But really, it's a bottom-up process first and foremost, with the macro just sort of being there to keep us from, just being blind to what might be going on from the top down.
Thank you.
Sure.
I have a quick question.
Yes.
Well, it's not too quick, but we've looked at a lot of firms for this space. You like how I used we there, Jason? So Jason's looked at a lot of firms, and we've narrowed it down to 2. So congratulations on that, because you obviously have done a really, really great job. I'm a numbers guy, so I like to look at the 10-year numbers.
Sure.
And compare. And when I like to look at risk, return, Sharpe ratio, tracking error, and downside capture. And in all 5 categories of 10-year numbers, the other firm has superior numbers. So here's your shot. Why should we use you instead of them?
Okay, so I'll say a couple things. One is our 10-year number contains 2014, so it's skewed by one really terrible year. I talked about learning from past challenges, and we can talk about why 2014 was such a challenging year for us, but that really weighs on our track record. Now, our track record, it's part of it, right? And so we'll put our track record up for 10, 20 years or 15 years, and we still think it's fairly competitive, but it does have that challenging period in it. Jason and the folks at ACG were a consultant of ours at the time, and we had client money with them, and we think they were great to us in that they held our feet to the fire. They challenged us. We had half of our office go down and spend a day in their office meeting with their consultants, their analysts, et cetera. And we went through and sort of helped them understand what the issues were in that year. And they opted to stick with us with their clients, and I think they and their clients were rewarded for it. So we've learned from that.
Touch on what those issues were.
Absolutely, yeah. So the one of them was biotech, as Jason mentioned, where biotechs became 12% of our benchmark. We historically didn't invest in biotechs because we want to be early, but companies with no products on the market were just something that we had a hard time with. We've since found a framework to invest in them because it's such an important part of the benchmark, but that year, small cap growth was really challenged. Biotechs were up 30-40%, and they were 12% of the benchmark. So that was a good chunk of what went wrong. The other one was on market cap. And I show you these slides where we're about 25-30% below the weighted average market cap of the benchmark. And back in 2014, we went through a period in 2013 of tremendous returns, and we recognized, like we did in 2021, the market was getting inflated, stocks were going to prices that just made no sense. And so we sold those stocks, and we reinvested them, and we found the best values in the microcap world. And so that ended up with a portfolio that at the time was 65% smaller than the benchmark from a weighted average market cap standpoint. And we learned pretty quickly, we traded one risk for another, and it was the wrong trade. And so we've changed that. We're very conscious now of where we are, not only from a sector standpoint and an industry standpoint versus the benchmark, but also from a market cap and other factors that might dictate performance. We want our stock picks to dictate performance, not our profile. So we've tightened it up to make sure that doesn't happen anymore. And then the other thing on the upside downside capture, those numbers, I'm a numbers guy as well. Brian and I complement each other very well. I kind of get more in the quant side of things. He kind of tries to stay more higher level. And I run the upside downside capture, and you can run it on a daily, weekly, monthly, quarterly basis, or peak to trough, trough to peak, and you're going to get 5 different answers. And so I think we've got some good data that shows even in the down markets, peak to trough, we've held our own and actually outperformed more often than not. And in the up markets, trough to peak, we've outperformed, I think, every single time. So if you look at it on a monthly or quarterly basis, you might get a skewed answer. But if you look at it peak to trough and trough to peak, I'm very comfortable with our track record there. Sure.
We understand the importance of a strong management team. Yours, when there's a 10% pullback, you guys review and potentially sell, whereas the other team, they look at 15 or 20%. I guess it's a 2-part question. One, when you see so much volatility right now, how often are you seeing that 10% pullback? And then also, what if you have really strong confidence in the management team, but you still see that pullback? Then what do you do?
Yeah. So the 10% pullback rule is a little more nuanced than that. That applies when companies have gone to our price target, we reviewed our price target, and we cannot, in our heart of hearts, we can't justify a higher price target. And then but we don't necessarily want to sell it because we know momentum can take over. We're not momentum investors, but we know it can take over and it can take great companies to really extraordinary prices. And so we use our 10% pullback rule so that the companies can go through our price target and continue to appreciate. But if they reach a new high that's way above our price target and then they pull back by 10%, that's what would trigger that 10% pullback rule. And as you say, in these volatile markets, we have to adjust all of our rules. These are not hard and fast triggers. It's not a quantitative model where it just happens. And so we have to adjust all of our rules during the volatility. Our goal being to take advantage of the volatility, right? And if we think there's dislocation, to add to stocks when they're down. But I would say to Mr. Thurman's question as well, one of the things that we've improved upon is not taking the bait so soon, so to speak, where I think in past times when we've seen things sell off and go from one price to another, it's been pretty tempted to buy them. They're down 30, 40%. But we've been more cognizant this year in saying, okay, they're down 30, 40%, but they're still pretty expensive. And we still love it. We still like that business. Let's hold on to our small position. We're comfortable if it's a really small position, we'll hold on to it. We've got one today that we've just been watching go down for a long time. They reported good earnings last night. The stock's up 25, 30% today. And so we're happy to not take the bait and the first fall. We're going to wait till we see that fundamental turn that we want to see, and then eventually we'll get bigger in the stock.
Thank you.
Great. Thank you all. Really appreciate your time. Appreciate the consideration.
Yes, thank you very much.
Bye.
Jason, would you address the ramifications of the soft close?
Of the soft close, that just means they're not, one
I
of,
know what it means, but the ramifications of it.
it doesn't mean anything to an investor that's in the fund. Once you get in the fund, that means that they're going to allow rebalancing into it or additions into the fund, but they're not marketing to additional investors. So we'd like to see that when strategies either soft close or hard close. A hard close would mean even if you're already in it, you can't add new money to it. And that does create some challenges if you need to rebalance. So most managers will try not to hard close unless it's a real capacity issue. So typically, you've heard from the two managers. We kind of try to highlight some of the differences in the two for you to help drive a decision. Ultimately, as Randy pointed out, we've narrowed down a broad universe. We're looking at hundreds of managers. I think most importantly, it's looking at what the qualitative factors of both managers, the stability of the firm, the repeatability of the process, the stability of the team. Hopefully, you're seeing performance numbers that are good. They have a strong track record, which both of these do. We're not trying to bring you the manager that has the best numbers right now. There's a number of other factors that go into it because we know performance will ebb and flow. The other big factor to consider that we're looking at is how does it fit in your portfolio? How does it complement your existing small cap value manager? And how does it fit within the overall construct of your portfolio to be the most complementary? I think you probably recognize a pretty big distinction between these two managers, even though they're both small cap growth managers. Loomis, a little bit higher quality. This particular strategy, because their small cap, pure small cap strategy is closed, this is a small to mid cap strategy. So they're going to go up a little bit higher in market cap. This Silvercrest strategy goes further down in market cap. Relative to Earnest, Earnest is a SMID strategy, small to mid value. From a style perspective, I'd say Earnest is more relative value. They're not a real deep value manager, but they will go up pretty high in market cap. With a Silvercrest, you're going to get a little bit more exposure to the smaller end of and micro cap that you're not currently getting today. From a diversification standpoint, Loomis runs a little bit more concentrated portfolio at the security level. Silvercrest is going to run a little bit more concentrated portfolio at the sector level. It's going to be more pure growth, going to have generally higher weightings to the primary growth sectors of technology, healthcare, and consumer discretionary. We're going to see that over time. As Randy pointed out, if we just looked at numbers, we're going to see a little bit better down capture numbers from Loomis, that higher quality nature, a little bit better up capture numbers from Silvercrest. One of the things that, as he pointed out at the end, we did do a lot of reevaluation and re-underwriting of this Silvercrest strategy in 2014 and 15, and we were actually comfortable with the explanation before that they were really just avoiding biotech completely because of the binary outcomes there. And what that means, biotech is, think of drug companies. Small cap drug companies typically are not earning revenue. And the outcome is either really good or it's going to be negative, because really good meaning they get FDA approval and they move on. That was creating a big headwind, and that was actually a 12% differential in their return from the small cap benchmark in 2014. They were down 7, the benchmark was up 5, most of which was biotech. They have changed their process a little bit, as they described, where they can get comfortable with some biotech names and are including that, but still not really change the risk return profile of their portfolio. Just to point out a couple of things, if you go to, in our book, tab 3, page 14. So this is what we call portfolio combinations. We're just looking at the market cap breakdown of what your small cap portfolio would look like if relative to the Russell 2000, the small cap benchmark, and the Russell 2500 small to mid cap. So for overall small cap, if you had half in Loomis and half in Earnest, or half in Silvercrest and half in Earnest. And you'll see that the combination of Loomis and Earnest, you've got about 18% in greater than 15 billion. So it's, you're combining two managers that that move up quite a bit in market cap, a little bit lower and a little bit below the Russell 2500 with the combination of Silvercrest and Earnest, which we'd expect, because Silvercrest is smaller, going to be focused more on smaller cap. The real under 3 billion, you don't have a lot of exposure at all with that combination of Earnest and Loomis. They're getting a little bit more with the combination of Earnest and Silvercrest. So just some things to consider as how these managers complement one another. Happy to take questions or address concerns or issues that any of you have.
How do you feel about that market cap allocation? Are you comfortable having more allocated to 3 billion below?
Yeah, I think as my talking points are trying to focus on Silvercrest and how they would complement Earnest. In our view, if you're asking us for our opinion and our recommendation, we think the best combination here in your portfolio would be Silvercrest and Earnest. Go back to overall asset allocation. We're trying to achieve a 7+% return over time with return expectations more muted. This really what we're talking about is 5% of your overall portfolio in small cap growth. It really, in our view, is designed to be a return enhancer. We've got risk reduction in a lot of other areas in the portfolio. So we're comfortable with a manager in small cap growth that is a little bit more introduces a little bit more volatility, but potentially a little bit more juice and upside capture. Again, both of these managers are very good. Just as we're trying to narrow it down and come to a conclusion, that would be our recommendation.
I think that's, I really appreciate that and how that, you know, what that means to our portfolio, and that we are looking for this piece to be the growth, a little bit more of a growth-oriented strategy.
Doesn't Loomis have a better tracking error?
Yeah, I think the tracking error we show in this book, Randy, are they're
5 and 10 year time frame?
the tracking error. So if we go to page,
Page 10.
so the 10-year tracking error to the Russell 2000 growth, I'd say they're pretty comparable. At the end of June of 22, they're both about a little over 6%. Silvercrest is 6.5%. You know, you're getting, so that's how much different, both of them are gonna look different than the benchmark. I think this is important to recognize that we're not getting benchmark exposure, pure beta with either of these managers. They're active managers, they're gonna take on relative risk to the benchmark. The big distinctions are in these up and down capture numbers. Silvercrest is gonna have a higher up capture, a little bit higher down capture. Loomis has had better down capture, meaning they've protected more when markets are down. Their up capture is a little bit lower. From a batting average on a 10-year standpoint, so batting average is the percentage of quarters that the strategy outperformed. Both of them are over 50%. Silvercrest is a little bit higher. You can cut the quant a number of different ways. I think the way we like to think about it more qualitatively, we recognize Silvercrest is going to be a little bit more higher octane and a little bit more focused on smaller cap and micro cap, an area that you're not getting necessarily with Earnest. Loomis, a little bit higher quality, will protect in down markets, but how does that complement Earnest? Again, both of them are very good managers.
Here, I like looking at the 1-year return for each year to kind of look to see for those things like was already admitted in 2014. There was a bad year, but it doesn't look like there was any really big year that they were carrying on, you know, one big home run, say in a prior years. But my scoring on, you know, just looking at straight out returns, they were 50-50. You know, Loomis had 5 out of the 10 years that they were better than Silvercrest, and Silvercrest had 5 out of the 10 years that, you know, they beat out Loomis on that. So, so that looked like that was probably a toss-up on that. I would say that on our schedules that we were looking at the blending and the mix. I did particularly like that the Silvercrest was in more of the lower caps, which helped, you know, I felt like that would tend to keep us from having creep, you know, moving up in, that we would have a really solid small cap investment portfolio there, as well as with Earnest being our value pick, that it would, I like the correlation of having, you know, somebody maybe a little bit more aggressive in the growth to help offset those. So I just wanted to put that out there, what some of my observations are.
Jason, do you have any different, or any opinion in the difference on the fees from the two companies?
Number one, I'd say I wouldn't let fees be the driver.
Yeah.
But if you go to page 6, a couple of things to consider. So With Silvercrest, it would just be a separate account. You currently have a separate account with Times Square. And just as a reminder as to what that means, they're managing a portfolio of securities, so you own the individual securities. You're not an investor in a fund with Times Square. And that's what Silvercrest is offering. With Loomis, there is the option for a separate account or a collective investment trust. The separate account, they don't have any flexibility on the fee. That's 90 basis points on the first 20, 80 basis points on the next 30, and we're talking about this allocation would be about, I want to say it's about 45 million. So that on a separate account, it would be about 85 basis points. The collective investment trust obviously is a better fee, and that would be the direction we would suggest you go. It's the same strategy. It's in a commingled vehicle. The only difference is you'd have to sell all the securities that you're in today and then invest cash into the collective investment trust. That fee is, with the operating expense, it would be about 69 basis points. With Silvercrest, we're able to negotiate a discount to their stated fee, which is currently 100 basis points. We were able to negotiate for this mandate a 20% discount. So your fee would be 80 basis points on the first 20 and 72 basis points on the next 30, so roughly about 76 basis points. So we're talking 76 versus 69 basis points roughly, so slightly higher fee. Part of that is it's a smaller strategy, focused more on the smaller cap. It's the relative differential. It's pretty comparable, I'd say.
Other questions? Jason? We're ready to take a vote? Someone has to make a motion. We need someone to make a motion on which one that they would like.
Okay, so do you need a motion for one or the other?
Yes.
Okay, I would entertain a motion for Silvercrest.
Record your vote.
Trustee Bryant, how do you vote? Okay. Oh, I see. I think that's everybody.
Okay, the vote passed 6-2, Silvercrest.
Do I? Paul's absent. Or can you come up? I can't understand. Paul's not voting. He's absent. Okay, right, okay.
Is that it for that? Okay, we're through that. Thank you, Jason.
Okay, I guess so. So this would come back, we'll get legal documents, the investment management agreement. I don't know if you want to take up at the same time a motion to, we will need to terminate Times Square, but it shouldn't be done until the agreement and funding is set up with the new manager. So perhaps a motion to allow staff to transition from Times Square to Silvercrest in the most efficient manner possible.
Okay, thank you. To hear a motion on what Jason recommends?
I don't know if we can actually do that because I need legal advice on that. I don't think we can actually do that.
Needs to come back.
We'll have to come back for that.
Okay, sorry.
Okay, so we have time.
Okay, let's go to item 4, approve the minutes of the last month's meeting of July 14th. I'd like to make a motion. I'd like to get a second. Record your vote.
Vice Chair, I was going to say, there's an error on item 4C2. It indicated that trustee Madera was absent, and she voted aye.
That's when your voting wasn't working and it didn't display for the public. So
Okay.
that's why I have to
Okay.
list it that way.
Thank you.
Okay, it passed. Now we go to the consent docket. Judgments in the month of July, in the amount of $61,026.43. Looking for a motion. Second. Record your vote. Okay, motion passed. We need to do each one of these separate. We can do them all at once. Okay, ratify approvals. We'll do those all at once. We see an A, B, C, D, and D has 5 parts to it. Looking for a motion? Second. Record your vote. Okay, motion passed. Number 7 is approve the claims docket. Record your vote. Motion passed. Number 8, following applications for service retirement. We have 1, 2, 3. Record your vote. Motion passed. Okay, number 9, report of death, approved continuation of pension to spouse. We have 2 items. Record your vote. Motion passed. Number 10, receive report of death, authorize payment of $5,000 death benefit, and authorize secretary to make necessary changes. Record your vote. Motion passed. Number 11, receive report of death, authorize secretary to make necessary changes to conform on the following. Record your vote. Motion passed. Number 12, receive report of death, death of employee on an active service, approved pension to spouse. Record your vote. Motion passed. Let's see. Number 13, we have 1 item, approve the following application of vested rights. Record your vote. Motion passed. Number 14, we have one item, approve request of the following to terminate vested rights and commence retirement benefits. Record your vote. Motion passed. We have previously done item 15, so we'll go to item 16, receive the investment consultant's report.
Okay, I'm back. We have a few things this morning, quarter report, the monthly report, and then some recommendations on redemptions from some of the underlying funds, K2 Ascent hedge fund platform. So I'm going to start in the quarterly report on page 20. You all have heard a lot about where markets have been, but just to, again, show a number of relative return comparisons for your portfolio, but I always think it's helpful to look at dollars. I know last month you had your actuary here, and the report was very good. As of the end of December, your funded status had gone up because we had several good years. The first half of this year has been very challenging, and we've seen markets sell off quite a bit. But I think if you look, looking here, particularly that 3-year column, the trailing 3 years, the portfolio has grown by $146 million. So in July of 2019, the portfolio value stood at $753.7 million. Net additions, that's contributions in less benefit payments and other expenses out, negative $83 million, roughly. That's to be expected for a mature pension system like this. You're going to have negative cash flow, but the return on investment of $146.7 million. So really a pretty strong 3-year period to end that at June 30 at $817 million. The 1 year, you can see, is a different story. We started July of last year at $943 million with net additions of about negative $26 million for the year. Return on investment negative $100 million for that 1 year period. The month of July was a positive, so I think you're up about $32 million in the month of July. So we know from month to month things are very, very volatile. For the month of July, the portfolio was up 4%, over 4%. Probably up so far in August. If we go to the next page, we just look at your portfolio versus some longer term objectives. While we'd like these to all be yeses, and it has been for some time, we do have one no right now, and that's on that 5-year relative return objective. Due to market declines now, the 5-year annualized return of 6.9%, a little bit under your 7% assumed rate of return. But over 10 years, we're well above that by about a little over 100 basis points or 1% over a 10-year period. Outperforming the policy benchmark, that's the second line, both over a 5 and 10-year basis, on a 10-year basis, quite a bit. And then we talk about risk. We want the portfolio ideally to have less volatility or standard deviation than the policy benchmark, and we've done that over both 5 and 10 years. And then beta, another measure of risk, which is sensitivity to the direction of the market. A number less than 1 means you have a little bit less sensitivity to the direction of the market, which means a little bit less risky. And then finally, down capture. Randy was asking about that with respect to an individual manager. We look at that at the portfolio level relative to the policy benchmark, and actually over a 10-year period, you've done pretty well. What that indicates is when the asset allocation, if you were invested completely passively, is down. If that policy benchmark is down 10%, you're only going to be down about 9.2%. So you've protected on the downside, which is what we're trying to accomplish. If we go forward a couple pages to page 24, on the right side of the page there, looking at returns over trailing periods, the quarter, 1, 3, 5, and 10 years, and I'll focus on that 10-year number. 10-year return, which I pointed out on the last page, of a little over 8% annualized over the last 10 years, outperforming the policy index, or what the asset allocation would suggest, by a fairly substantial margin, about 80 basis points. And then we can also compare you to other public pension funds. That's that IM, which stands for Investment Metrics, which is a database of a peer group database. The median in that peer group over the 10 years, up roughly 7.7%. So your return ranks in the 29th percentile over that 10-year period, meaning you're outperforming 81% of peers. So the 3, 5, and 10-year peer group rankings all near the top quartile, top third. 1-year return a little bit below median, and then the quarter a little bit above median. In the lower left, just looking at calendar year returns, which just ties in more to your valuation, the last, really 2017 through 2020, you had really strong relative returns each year, even in the down year of 2018. 2019 and 20, very strong absolute returns, and 2021. This portfolio really expected to get about a 7% return over time. You see the last 3 years, 4 out of the last 5 years, double-digit returns. That's what's benefited your funded status dramatically. We know that's not to be expected every year. We pushed a lot of returns into the last few years. Now, if we could, just turning to the monthly report before I touch on the ASAP, on the equity long-short review. As I mentioned, July was a very strong month. We've started to see at least indications that some of the inflationary pressures are starting to abate a bit as a result of Fed policy and tightening. We know the Fed funds rate is up to 2.25% now. Expectations are that we'll probably see another couple of raises, depending on where the data goes. It may not be as steep as it was in the last couple, which were 75 basis points each. But we're starting to see the market react. Longer-term rates, 10-year treasuries down close to almost 100 basis points. Mid-June, it was about 3.5%, down to close to 2.7% now, we've seen bonds go up as treasury rates have come down. We do still have what is referred to as an inverted yield curve, where shorter-term rates are a little bit higher than longer-term rates right now, which is an indication potentially of a slowing economy, and it's been an indicator of recession in the past. We have seen a pretty big bounce in equities. As you'll see, the total portfolio up over 4% in the month of July, with equities really up 9 to 10%. U.S. equities, you see there, large cap up over 9%, small cap up over 10%. Those are pretty big bounces in the month of July, and we're seeing that continuing here in August, so that's benefited the portfolio a bit. Now the 1-year return of the total portfolio is still a bit behind. We've fallen a bit behind the policy index. We've talked about this the last few meetings. A lot of this has been the large cap portfolio. It's down about double what the large cap benchmark is. This is primarily in tech, which is it's intended to be a benchmark risk-controlled strategy, but they tend to overweight smaller names within the large cap benchmark. That was a headwind in the first half of this year. It actually benefited you a little bit in the month of July, and it was a benefit in 2021 and 2020. The small cap portfolio basically in line. Long short equity, which we're going to talk a little bit about, these numbers are very disappointing, down 20% whereas the ACWI, which is the long-only global benchmark, down 10. The spread has widened a bit, and that's with markets up in July. We're getting a bit whipsawed while your long-short equity portfolio was up almost 5% in the month. When long-only markets are up as strong as they were in that bounce, that's spreading that margin a little bit wider in the near term. As we'll look at when we look at the history of your hedged equity portfolio, it's done what we would expect it to do over time, which is protecting in down markets pretty substantially in 4 out of the last 5 from peak to trough drawdowns. It's been the most recent drawdown from really this calendar year from December to June, where we were down about in line with the long-only benchmark. Why you're seeing such a dispersion from that long-only benchmark is on a 1-year basis, now going back to last summer and including July of this month, the months where the market has been up, long-short equity hasn't been up near as much. So it's more not being up as much when markets are up than not protecting on the downside, although January was a month that was challenged. Private equity continuing to perform well, a little under 11% return. You are seeing, and we would expect to see this, as these aren't marked to market on a daily basis like your public equities. We would expect to see marks come in this quarter down a little bit, but certainly nothing like what we're seeing or what we've seen in public markets. So far, we've seen marks with some of the portfolios down about 3 to 5% on a quarter-over-quarter basis. On the international side, again, a good month outperforming the benchmark. Some of the things that hurt over the trailing year, the growth components that really sold off in the first half of the year have bounced back a little bit more in July, getting outperforming the benchmarks. Fixed income, positive return for the month, a little bit behind the benchmark. And then finally, real estate has been the best performing asset class. 3, 5, and 10-year return still very strong. So I want to turn to the long-short portfolio because we do have some recommendations here. Just for some of the newer members on the board, or maybe a reminder or a refresher as to what we've done here. Prior to 2018, you all were, since 2005, were in a long-short equity fund of funds managed by K2. It was so K2, the manager, put the portfolio together. It was a commingled fund where other investors were in it, and they managed the allocation and the underlying managers in that portfolio and rebalanced as they saw fit. Over that time, we got returns in that were very good in down markets. That it provided a lot of protection, but what as we analyzed that, as well as other clients' portfolios that were invested in these off-the-shelf fund of funds, was where we're getting a lot less market participation than what our capital market assumptions were expecting. We really expect to get about 2/3 of the return of the long-only markets with about 2/3 of the risk. What we ended up seeing was we were getting about 30% of the risk because of how conservative these portfolios were, and about half the return, or a little bit less. So we went and evaluated different ways to get a more customized approach to your long-short equity allocation. And K2 was able to provide what we call an unmanaged fund-of-funds equity long-short fund-of-funds platform, where we were able to design that alongside of K2 with managers that they underwrote and evaluated to put on the platform, but we were able to control the dollar amounts that went into each underlying manager. In exchange for that, you saved significant fees. well over 101% in fees, and able to implement a long-short portfolio much more efficiently. But it requires the board, along with us, when changes need to be made, to make those decisions that you didn't see before. And so today, we're coming back to you with some recommendations to make some redemptions from funds that are on this platform. But as you'll see from the material, these aren't daily liquid funds, and it requires putting in notice, and then it's going to take some time to get some money back. As we've evaluated this, we feel that this portfolio has shifted a little bit to the bias to growth, specifically tech and healthcare, and we want to unwind some of that and reposition that. But it's going to take some time to do that. So if you just go to the first slide, the executive summary, effectively, today you're at 69 million or 8.5%. This was at the end of June on the Ascent platform. Your target is 10%, so we're a little bit underweight. Currently, you're invested in 11 different strategies. We're recommending a full redemption from 3 of the 11 today, Trian, SQN, and Swift Current, for various reasons, qualitative reasons with each of those underlying managers, but also in an effort to get us to reduce some of that tech healthcare bias in the portfolio. The effective dates and distribution dates is going to be dependent on each of the underlying funds terms, and we put that in here. We would anticipate coming back to you with additional recommendations in the future as to repositioning among existing managers, but that's going to take some time as well, and potentially adding additional managers within this. So this is simply a recommendation to put these redemptions in, and it's probably, there's a lot of data, but if you go to page 10, there's a lot of information on here, but the requirements to put redemptions in, they're different for each fund, and there is a notice period that in some cases you'll see for SQN, it's 65 days. So the next available liquidity date to get out is December 31, and the notice would have to be in by October 27th. And then there's a 25% investor level gate, which means each quarter they're only going to, beginning at the end of December, they'll distribute 25%. For Swift Current, it's a little bit more restrictive. The Swift Current Bridger, you can only get out on the anniversary date of your investment. You made 2 investments in Swift Current, the first on August 1, 2019, and the second on March 1st of 2020. So the next available liquidity is going to be in February of 2023 for that second tranche. And the first tranche, we won't be able to get that back, but we're still, we can put these notices in early and just get this in place. And then finally, Trian, it's quarterly liquidity with 95 days notice. That one is going to be September 27th. So again, we're trying to do things well in advance just to tee it up, but it requires us coming to the board. So our recommendation is to put in full redemptions for each of these 3 funds at this point in time, and then that cash will come back as it's coming back, and it will just go into your cash account, and we'll decide how to redeploy it in the future.
Since we talked about process earlier, I was looking at this too. We're to receive this report, so I think we can receive the report, but I don't know if we can actually advise. Am I right? That's why I was looking for you, at you, Brett. So, okay, so we'll have to bring an item back next month to formally tell us, because this is an action, you're seeking an action from us, and the way the agenda is, it says receive, so we'll have to change that next. Okay. All right.
And that will be okay because the first notice is 9/27. So just tune that up.
Correct, yeah, I think you got plenty of time. I was getting nervous until I saw your dates there, and I thought we were okay, so
So
thank you.
I will just, so that's the bottom line of this recommendation. I will turn your attention to page 8, because we ran this analysis just to reiterate what we're trying to do here. And historically, we're looking at here, this is from peak to trough, what we call a drawdown. And I think Steve Lilly at Silvercrest was talking about this, depending how you look at it. But this is just the period of time where the long-only market has gone down. The 5 worst periods really over the last 15 years since you've had long-short equity. This one period now from December of 2021 through June of 2022, down about in line with the long-only market. It is fairly unique. If we look at prior drawdowns, 2007 to 2009, the financial crisis, your long-short equity protected pretty dramatically. The COVID pandemic from December of 19 to March of 2020, down less than half. 2018 protected up by about 30%, 2015 and 16 protected. So this has been a fairly unique period. Some of it is due to portfolio construction and drift. This portfolio moving a little bit biased to tech and healthcare, which is an area that has just been slammed over the last 6 months. And so we want to try to mitigate that to some degree. So we'll bring this back next month in the form of an action item. That's all I have.
Okay, we're ready to approve item 16. Please note on number C that we're just voting on the review. We're not voting on the recommendations. There we go. Record your vote. Motion passed. Okay, comments from the board, staff, citizens? Hearing none, the meeting's adjourned at 11:51.